We talked about starting from net earnings, and then we get down to cash flow from operations by making all these adjustments for non-cash items. Okay, so people care a lot about the ratio of those two, and it's called the quality of earnings ratio. And it's calculated as the cash flow from operating activities divided by net earnings. Okay, as we saw in the last example, this can be pretty significant, right? Our cash flow from operations is 10 million relative to 4 million of net earnings. That's 2.5 times, right? So that quality of earnings can tell you people care more when it's a really small number, meaning you might have really positive net earnings and negative cash from operations, or very low cash from operations. That might indicate a problem, right? Because typical accounting fraud occurs by booking revenue and debiting accounts receivable and never collecting the cash. All right, so that was the operating segment. We're going to focus on the investing accounts, okay, for the investing section. So we care about these long-lived assets, property and equipment. Notice how it shows net. That net means net of accumulated depreciation. And then some computer software. So we care about how much cash was spent to acquire property, plant, and equipment, and to acquire computer software. Okay, we have to individually report the cash used to purchase the equipment and the cash proceeds received from the sale of equipment. You can't net them. It's important to see both numbers. Okay, so how did we get this 3974, acquisition of property and equipment? Well, it makes sense that when we acquire plant and equipment, we're losing cash, right? Credit cash, debit property, plant, and equipment. But if we look at the statement of financial position, we see that property, plant, and equipment has increased by 608. So how did we figure out that we actually spent 3974 on property, plant, and equipment? Well, we know that the total account increased by 608, and we know that we had depreciation of 3366. Therefore, the account has to have increased by 3974. We had to purchase 3974 worth of equipment, less depreciation of 3366, because this is presented on a net basis, will give you a net increase of 608. I would recommend using the T accounts, right? The T accounts are nothing new. Don't have a lot of room here to show it. So here, I'll show it on this slide. If you have your T account for P, and E, okay, you know, and then let's go back. We know that our ending balance is debit of 15012, right? So 15, what was it, 012? Is that correct? Our ending balance was debit 15012, credit, and the beginning balance was 14404. Okay, 14404. And we know we booked depreciation. And depreciation, remember, reduces the net book value by virtue of increasing the accumulated depreciation account. 3366, we need to solve for X, right? How can we go from 14404 minus 3366 and get up to 15012? The only way is by spending 3974. Okay, so X equals 3974. Okay, the acquisition of computer software works the exact same way. We know that the net balance decreased by 328 year over year, yet depreciation was 380. So we know that we have to have spent 52 on computer software in the year. Okay, but notice how these two items are not part of operating activities because these aren't part of working capital. These are long-lived assets. The capital expenditures ratio, you'll often hear capital expenditures referred to as CapEx and operational expenses referred to as OpEx. Okay, so the CapEx ratio is the cash flow from operating activities divided by the cash paid for capital expenditures. It reflects the portion of purchases of PP&E, intangible assets and other businesses that were financed from operating activities. That's like saying if you went out and bought a new car for $10,000, you might care if that cash is coming from selling an old car versus working for 6 months to save up for it, right? Operating versus investing, or going to the bank and getting a loan that's financing. A high ratio indicates less need for outside financing for current and future expansions. All right, so free cash flow. All right, we're in luck. So, this ratio is actually pretty important. It just depends on how you define it, what numbers you use. All right, so let's look at some of the financing accounts. And so this is going to be the third section of the statement of cash flows. Remember how we said this is going to be dividends? Okay, anything that's impacting our shareholders. In this case, it looks like we don't have any long-term liabilities, but that would also fall in this category. Long-term liabilities meaning bank debt. So I got a good question during the break, and that was, where do we get these numbers from? These will have to be given to you, okay, because you can't, just by looking at the balance sheet and the income statement, there's no way to know that new shares of 99 were issued and the company repurchased 219 of its own shares for net outflow of 120, okay? Now, the 120, you should be able to see here, contributed capital decreased by 120. So the only way for contributed capital to decrease on a net basis is to repurchase shares. So if I were on a midterm to say, if I were to give you this information, this balance sheet, and the only information I were to say was the company did not issue any shares during the year, I would expect you to be able to know that contributed capital declined by 120 and there is no new share capital issued, therefore the company repurchased $120 of its own shares. And that repurchase transaction might seem a little counterintuitive to you. You're like, what is it actually repurchasing? Remember, it issued shares to us for money when it first incorporated. The same way that you can go to the market and buy a share of Google, Google itself can go buy a share of itself. And Google might do that to retire the share. Okay, the reason it does that is because it effectively cuts the same size pie into fewer pieces, meaning the pieces are bigger for the existing shareholders, right? If we have 150 shares outstanding, and ePhone has some excess cash, and we decide to buy out 50 of our shareholders, okay, the company is still worth the same amount of money, less the cash, except now the equity is split between 100 people instead of 150 people, right? So that's why companies choose to repurchase shares. But again, in this case, you were given the information of they issued new shares of $99 and the company repurchased $219. On a midterm, I only need to give you one of these because you know what the total or the net inflow or outflow is by virtue of the comparative statement of financial position. Notice how these show up, these two lines show up separately, right? Issuance of shares and repurchase of shares. Okay, so here's another tough one. Payment of dividends. So again, you're not going to see this explicitly. We know retained earnings, right? We have this dividends payable number. But how do we know that they didn't pay other dividends during the year? Dividends payable just means at the end of the year, we still owe our shareholders $708,000 of dividends. Most companies pay dividends quarterly or semi-annually. So how do we know what we paid halfway through the year? Well, you need to use your knowledge of the retained earnings account. Okay, so 708, dividends payable of 708. Let's show you where that comes from. Dividends payable, 708, implies that we've declared the dividends, meaning we've booked the entry debit dividend, which is the retained earnings account, credit dividends payable, the liability account, but we haven't yet paid it in cash. Why is that showing? Okay, yeah. So that's the. Sorry, I confused myself there. Even this is not the most straightforward stuff. Okay, so let's look at our retained earnings account. Okay, so our opening retained earnings was $46,768. And here's last year's balance, right? Our retained earnings was $46,768. And we know that we add net earnings of $40.28. Okay, the $40.28 is just right from here. And we subtract, we know, okay, we have 708 dividends outstanding. Okay, and we know that our ending retained earnings is $48,964 because we can see that here. So the missing piece here is we must have paid more dividends because if you were to take opening retained earnings of $46,768, add net earnings of $40.28, and subtract the dividends declared but not yet paid of $708, you would get to a higher number. But you know that your ending retained earnings has to be $48,964, and therefore you calculate the dividends that were paid in cash throughout the year. Okay, I would suggest, again, building a T account to keep track of your debits and credits, because otherwise you can't do this in your head. I mean, maybe some people can, but most people can't. So if this is our dividends T account, or our retained earnings T account rather, we start with a credit balance of $46,768. We have net earnings, remember which increase, retained earnings, $40.28. We know we booked an entry for $708, and then we know that our ending balance is $48,964. Notice what side of the T accounts I'm on. I'm on the right side, right? That's credits. The left side, I only have one entry, that's a debit, that's a dividend paid. So you know you have to have another dividend paid for X. So you solve for X and you'll see that X has to be $11.24. Okay, so these are all reasonable questions for the midterm, or rather, you sort of need to imply these numbers on your own. You need to be able to think, what's given to me? First of all, presume that I'm giving you enough information. Because I got a lot of questions during the midterm saying you didn't give us enough information. Well, I did. I gave you exactly enough information. I would only leave out one variable. I can't give you two missing variables and expect you to solve. I will always give you enough information, so use that as sort of, I'm not here to like give you an unsolvable problem. You just need to know how to calculate that missing piece, okay? Notice how as the course is progressing, the focus is more on what is the amount to book. The underlying journal entries, statements of financial position, statements of earnings, statement of cash flows, those will never change. We'll be using journal entries right through to the end of this course. Remember, they're just a tool, they're just a mechanism. As we advance in this course, we'll understand more about what numbers we're booking and why we're booking them, how to calculate that number, okay? That's why it's so imperative you have a very good understanding of debits and credits and journal entries and T accounts today. Because as we move forward in the course, I'm just going to assume that you'll be able to solve for some of these numbers, right? Like the assumption with this example is you were able to solve for 1124 payment of dividends just by looking at the retained earnings account. Interpreting cash flows from financing activities. So generally speaking, a company can only get money from a few places. One is internally generated funds, that's operating activities. The second is issuance of shares, going to shareholders and saying, can you give me more money? I'll give you shares. And the third is going to banks. Those are the only ways a company can generate money, right? So the statement of cash flows really shows you where cash is coming from that year. You might, if you're an investor and you only have the statement of financial position and you see cash increased from $100 to $1 million, you might think, wow, this company's doing really well. But then you look at the statement of cash flows and you realize they generated all that cash from selling all of their property, plant, and equipment and taking on debt. And their cash flow from operations was zero. Well, what do you think of this company now? Sure, they had cash on the balance sheet, but where did it come from? How are they using it, right? You'll see this word used a lot, capital structure. And we'll get into it a little bit more. This is more finance. The capital structure of a business is the ratio of debt to equity. Note it, and that's your liabilities and shareholders' equity. Remember, your assets are always going to be equivalent to your liabilities and shareholders' equity, okay? The ratio of the liabilities to the shareholders' equity is very important to the risk of the business. If you have a business that's funded 100% by debt and your revenue drops even a little bit, you might not be able to make your interest and principal payments. If you have a business funded mostly by equity, you're relatively lower risk because you can't really go bankrupt because your equity holders can't enforce you to pay dividends or repurchase share capital, right? Dividends are non-contractual. So the capital structure is how you look at the right-hand side of the balance sheet or the liabilities plus equity, and it implies a lot about the risk of the business. Okay, so the last step here, notice how we have the three segments done, and we know the cash either provided by or used in the operating activities, the investing activities, and the financing activities. Okay, the last component is to reconcile to the ending cash balance on the statement of financial position. If we go back to the statement of financial position, we see that our cash balance is $33,553, and it was $28,698. The change was $48,055. So here's a big reveal. Notice how when you sum, this is covering a little bit, but when you sum the cash from operating activities, cash from investing, and cash from financing, you get $48,055. And when you add that to your starting balance, you get your ending balance. It's not a coincidence, right? It has to balance because we're using all the numbers from the statement of financial position. Okay, so IFRS requires what's called additional disclosures on the statement of cash flows. So you have to show a reconciliation of net earnings to cash flow, which we do have, right? That's where you start from your net earnings of 4 million and cash flow of 10 million, cash flow from operations of 10 million. You need to show the cash amount of interest and dividends received and paid, as well as cash paid for income taxes. What you'll often see is at the bottom of the statement of cash flows, there will be another line saying cash paid for interest during the year, cash received from dividends during the year. And significant non-cash investing in financing activities. What does that mean? Example, purchase of a building with a mortgage. So depending on the structure of the transaction, I mean, there's two ways to show this, right? One is you took on debt. Let's say you bought a building worth $1 million and you took on a mortgage of $800,000, right? One way to show this is increase in bank debt, $800,000 in your financing activities, and then show an outflow of cash of $1 million in your investing activities for acquisition of building, right? Depending on the structure of the transaction, it might just be recorded as acquisition of building, 200. Well, you're not showing that you actually took on a lot more debt. So they want you to disclose any significant non-cash activities. Other non-cash activities are you can actually give equity in exchange for an asset or a business, right? Rather than paying in cash, you can say to someone, I'll give you shares of my company. That's how software engineers in California get paid. They get paid some cash, a lot of cash, but they also get Facebook stock. So when Facebook goes public, they all make millions of dollars, right? It's like stock options. Okay, so this is the last section. It's a little bit tough. I know it's an appendix, but we need to know it. So we're looking at adjustments for gains and losses on the sale of long-lived assets under the indirect method. So this is just the sale of property, plant, and equipment. Okay, remember gains and losses are different than revenues and expenses from operating activities because gains and losses are non-recurring, they're one-time, they're not part of our normal operations, right? So again, I'll just remind you, what's an example of a gain or a loss that we might realize on the sale of a long-lived asset? We might have bought a plot of land and put a warehouse on it. Warehouse wears down. We decide, we're just going to sell the warehouse and the land to a third party. We don't need it anymore. And over the last 25 years, the land has appreciated greatly in value. It's gone from $100,000 to $1 million, right? The land would have been carried on our books every year at $100,000. And when we sell it, what's the entry going to be? Debit cash, $1 million. Credit land, $100,000. We have to get rid of it from our books, but our entry's not in balance. We credit the difference to a gain, okay, which is it's an income statement account, and you can think of it broadly as being a revenue, but it's not an operating revenue. So the question is, how do we account for that on the statement of cash flows? So transactions that cause gains and losses should be classified on the statement of cash flows as either operating, investing, or financing. Most of the time, it's going to be investing, okay? When we sell that warehouse, we're going to show proceeds from sale of warehouse or proceeds from sale of land, okay, on the investment activities section. Because remember, it's not related to our working capital. It's related to our property, plant, and equipment. So we sold the warehouse for $1 million, and we're going to show proceeds from sale of warehouse and land $1 million on our statement of cash flows on the investing section. That's nothing new. Here's the problem. We have a gain sitting in our net income of $900,000. Therefore, we have to subtract the gain from profit to avoid double counting it. Because we're already recognizing the fact that the book value of our, that the fair value of the land far exceeded its book value. We're picking that up by saying $1 million of cash inflow on the investing activities section. That includes the $900,000 gain. Okay, so what we have to do on the cash flow from operating activities is we actually back that out as a non-cash item. Losses are the same conceptually, but work the opposite way. If we have a piece of equipment that we bought for $100,000, turns out we don't need it, and we try to sell it and no one else wants it, so we sell it for $10,000. What's the journal entry? Credit equipment, $10,000 or $100,000. Debit cash, $10,000. We're not in balance. We recognize a loss, right? We lost $90,000 on that. When we show the investing activities section, we're going to show proceeds from sale of equipment for $10,000. The thing is, we also have a loss sitting in our net earnings. We have to add back that loss because it's artificially bringing down our net earnings. So this just explains exactly what I said. The important thing here is you compare the proceeds received in excess of the net book value. Remember, the net book value is the cost minus the accumulated depreciation. Okay, so if we bought this originally for $10,000 and we sold it for $8,000, you might think, oh, that's a loss of $2,000. No, because we've depreciated already $4,000 of it, so its net book value is actually $6,000. We actually have a gain of $2,000 here. Here's that journal entry that I just described. It's just a little bit more complicated. You have to remove the equipment or the land, the long-lived asset, whatever it is. You have to remove the equipment from the books. You also have to remove the accumulated depreciation. Because these accounts accumulate balances separately, right? Notice how the depreciation expense, the entry to record depreciation expense isn't debit depreciation expense, credit equipment, debit depreciation expense, credit accumulated depreciation equipment, which is a separate account. It's a contra account, right? So what we have to do is, if we realize cash proceeds of $8,000, we know we're debiting cash for $8,000. Okay, we have to remove the original cost of the equipment because it's still sitting on our books at the historical cost of $10,000. That hasn't changed. So we have to credit the equipment to get it off our books to show zero balance in that equipment account. And then we have to remove the accumulated depreciation. Remember, accumulated depreciation has a credit balance. So we have to debit it to zero it out. We no longer have this piece of equipment. We can't have the asset on our books or the accumulated depreciation on our books. So that's why you see this sort of inverse transaction of credit equipment $10,000, debit accumulated depreciation $4,000. The difference here will be the gain, right? Or loss. That gain or loss depends on the cash you realize. If you realize less cash than the net book value, you're going to have to plug the debit, which is a loss. You wouldn't believe how many people got this wrong on the midterm. So it's an important question. It's really not that challenging when you think about it, but if you don't practice it and you haven't reviewed this, it's going to be hard to do on the midterm, okay? So just think of everything that's happening, right? There's a lot happening. If you try to think of all four accounts at once, you might get it wrong. So think of it piecemeal. Think of, okay, we're getting cash. You know debit cash. You know you're getting rid of equipment, so you have to credit the equipment. You know that if you're getting rid of the equipment, you have to also get rid of the related account, the accumulated depreciation account. So that's a debit. And then you know that your journal entry has to balance. So you know the difference has to be either a gain or a loss. So think of it, try to think of it in steps. Don't just try to think of what's the whole journal entry. And so this just describes what I said regarding double counting. So remember, the indirect method begins with net earnings, which includes that gain, right? That gain gets shown as part of our, if you think about our classified income statement, we have revenue, less cost of sales gets us to gross profit. Then we have operating expenses, and then we'll have non-operating gains and losses, and then we'll have earnings before income tax. Then income tax, and then net earnings. right? So that gain is buried, or that loss is buried in that net earnings. Well, given the treatment of cash versus non-cash items, it would seem that the gain doesn't have to be adjusted because we receive that money, right? We receive the cash. The reason we have to remove it from the operating section is because it's already implicit. When we record this transaction in the investing section of the statement of cash flows, we record proceeds of $8,000. We don't record proceeds of $6,000. Even though the net book value is $6,000, we record the actual cash received. Either $8,000 or let's say we received less. Let's say we only received $1,000. Right? So the investing section of the statement of cash flows is going to show 8,000 proceeds. And that 8,000 is made up of our $6,000 net book value plus the $2,000 of gain. All we're doing is effectively moving that gain from the operating activities to the investing activities, which makes sense, right? We want to capture what the ongoing operations of this business will look like, not what a one-time gain looks like. And that's it for chapter 5. So